Good morning and good afternoon, everyone. It is September 4th, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you're a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today we have Derek Kam, Asia economist, Robin Xing, Chief China economist, Takeshi Yamaguchi, Chief Japan economist, Chloe Liu, China agri strategist. During this broadcast, you can send us questions at any time from the Ask a Question text box. After Modi and Xi meet up over the weekend, our Asia economist team published their thoughts on the India and China trade. So today we have Derek here to share his thoughts on why they think further expansion in the bilateral trade is possible. Over to you, Derek.
Yeah, thanks a lot, Crystal. I'm just going to share my screen and sort of highlight some of the key charts that we have put out in this particular report. But I think at the outset, as what Crystal was mentioning, we were sort of saying that, look, there would be sort of like an economic imperative for bilateral trade to actually expand between China and India. So at the outset, I think let's just look at where the trade relationship is at the moment. If you look at it from an overall perspective from India's side, whether is it sort of like total exports and imports, and whether the size of the trade deficit with China, we are actually seeing that China is already India's number one trade partner from all of these aspects. But from the flip side, from China's perspective, yes, India sort of ranks it sort of after the US and Europe, but it is nonetheless also the largest sort of trade partner within Asia itself. So why do we think that actually there is actually this economic imperative for trade to further expand between the two nations? The first outset is to sort of understand and recognize that as we sort of return in January this year, there is a greater need for India to actually get into the global manufacturing supply chain in order to be able to create jobs and rapidly industrialize to solve for its unemployment problem. And then what we are highlighting here is that there needs to be an acceleration of the efforts on India's side to align the manufacturing production with the global demand. And so what we are showing here is really what you can see from a global export share by product category. You can see that, it's really in areas like electrical machinery and equipment, machinery, and mechanical appliances, things that have actually been sort of the highest market share. And I think it's also not a coincidence that given that China is the number one manufacturer in the world, China is very, very competitive in a number of these key product segments that we have talked about. And also you can see here the sizable global export market share for multiple key products is over there. And so therefore, in that sense, that's where the first starting point is, where as India needs to sort of get onto the supply chain for these sectors where China is already a key player, there can be a sort of like potential for both of these economies to sort of cooperate. There are a couple of other reasons why we sort of mentioned that. I think if you look at sort of where China's industrialization process had actually been in the 1990s and the 2000s, China itself had also sort of benefited from increase in FDI flows from other developed nations at that point in time. Economies like US, Europe, and also the other Asia economies which have already industrialized, like for example, Japan, Korea, and Singapore. And so if you juxtapose that position today into today's context, India is probably exactly where China was maybe 20 to 30 years ago, and could therefore also benefit from the FDI flows from China. Having said that, the share of the FDI inflows have actually been pretty low since 2020. Previously it was on the rise, but there was also sort of like a decline shortly after, sort of just a bit after COVID. And there are sort of reasons to believe that this has been constrained by a strict approval process. Nonetheless, recent media reports are suggesting that these processes there could be some easing in those processes, which could actually help to accelerate the improvement of FDI inflows from China. The second thing is that really, China can actually provide critical inputs for manufacturing to India. And as we can see, as it is the case right now, industrial supplies are about over a third of imports from China from India's perspective. And we do think that there is room for this trade to also expand. And then the thing is that the backdrop to this is also, again, coming back to China's very dominant position in global manufacturing chains, and its share in value chains is at 41%, which is the highest. India is currently at 4% right now. And so if India does want to actually get onto and align its production structure, I think it stands to reason that we should expect China to actually play a big role in this in terms of providing the critical inputs, given its dominant position in this space. The third reason as to why is that India also needs the capital goods imports to build up its manufacturing sector. And if we look at the composition of the imports from China, about already 56% were already in capital goods in 2024. And as India continues to rapidly industrialize, it will probably see an increase in this trade. Most of it will actually come from China. Then from China's perspective, I think what is interesting is that China also can leverage on India as a significant sort of like growth opportunity. As we know, there's trade tensions that's going on between US and China, and it's going to be sort of like a bit more challenging for China to be able to export to the US. And so what we've actually seen is that the trade surplus that China is running with the US has actually already come down, whereas the trade surplus that is running with India has come up. And we expect sort of like, this to move in the same direction going forward as well. And as it is, we know that China has already expanded its market share in exports of emerging markets by about 43% or so. And so India, as the second largest and also the fastest growing EM, will represent a very sizable growth opportunity for China. We've already seen this play out in the areas of cell phones, but we also do expect these to broaden out to other sectors as well. Now, one of the challenges that people sort of raise in the context of this bilateral relationship is that, well, if you have a widening trade deficit with China, and you also currently have a sort of current account deficit in India's context, wouldn't it be necessarily the case that a wider trade deficit with China would also widen the current account deficit? Now, to answer that question, we actually look at the relationship sort of between Vietnam and China. And here in this chart, you can see that even though Vietnam has actually widened its trade deficit with China over time, its overall trade balance has actually gone into surplus territory. And that is because Vietnam is able to actually sort of get onto the manufacturing exports, increase its value add within the production sector, and so therefore able to translate that into sort of like an overall trade balance. And again, we think that something like this, something similar like this could actually happen in India's context. So in a nutshell, trade is quite substantial right now between China and India. But given the four reasons that I have mentioned, we do expect further expansion of this bilateral trade relationship. I'll stop sharing over here. Back to you, Crystal.
Thank you so much. Thank you so much, Derek. And I will save all of the questions to later part of the webcast. So now we are moving on to China. Our China strategy team have published a report on the sector assault implications from the China anti-involution campaign. So today we have Chloe here to share the key takeaways in the report. And also we have Robin, who just came back from Beijing and Shenzhen, who will share his feedback and then also what the market is talking about. Over to you, Chloe, first.
Sure. Thank you, Crystal. Just as Crystal mentioned, we published a collaborative report on the anti-involution with our accounting and tech team this week. So in general, we think this round's anti-involution reform is a multi-year effort with a positive long-term impact on the earnings and ROE in the medium to longer term. But comparing to the supply side reform in 2015 and 16, we think the anti-involution this time involves more downstream sectors and requires more nuanced understanding and execution for each sector. So in this report, we have laid out three scenarios for discussion, considering the anti-involution execution and the potential demand side stimulus. So in our base case, we assume that the measured execution on the anti-involution is a more market approach instead of a campaign style. And we also assume some structural reform to rebalance the economy, such as social welfare improvement, local government KPI fine-tunings, and also tax system overhaul. So as a result, gradual reflation remains our accounting's base case. They expect the GDP deflator to turn positive in 2027. This is unchanged comparing to the previous forecast, but the level of conviction has become stronger because of the anti-involution. So as a result, we think for MSCI China's ROE, it will improve gradually from 11.6% at current level to around 13% in 2030. This will be slightly above MSEM's average ROE at 12.6%. So on the sector implications, we have a sector pecking order. So basically, this is based on our 3P framework. We look at the priority, progress, and potential to decide the sector pecking order. So in conclusion, we think for sectors like EV battery, steel, cement, and airlines, they offer more room for improvement and also higher upside from the anti-involution efforts. But for sectors like auto and China Delivery Express, they may see some downside risk despite the ongoing meaningful progress. We will discuss the reasons later. So next we will discuss the 3P framework. First, for the priority, let me find the chart. For the priority, basically we look at the six matrix in 3 dimensions to gauge the sector competitive landscape and also the urgency of the anti-involution. So first, for the priority side, for the profitability, we look at the gross margin and the ROE. So this is the table which shows the priority, the heat map. So for the gross margin and ROE, we both look at the 2024 level as a percentile of the last 10 years level to gauge the urgency. And secondly, for the operating efficiency, we look at the asset turnover ratio and also the inventory turnover days. And certainly, we also look at the capex and also the net gearing ratio. So as a conclusion, we found for sectors like solar, airlines, chemicals, and auto, they are among the sectors with very high anti-involution urgency, and they have the lowest profitability, operating efficiency, and also the highest capex and net gearing comparing to the historical level. And then secondly, for progress, so basically we look at what has been announced so far. This including the very specific capacity cut target, the sector self-discipline measures, and the potential MIAs. So in this table, we have summarized the current progress of the anti-involution for various sectors and also the hurdles and challenges we see for each sector. So in summary, we see for sectors like cement and coal, these 2 sectors have the meaningful progress so far. And lastly, for the potential of the anti-involution, we think 6 metrics are very important to look at to gauge the anti-involution potential for success. So overall, we think for companies with higher SOE market share, higher percentage from the outdated capacity, and more concentrated market share landscape, and also lower profitability level, for these sectors, they will have more incentive to do the anti-involution, and it's easier for them to reach a feasible plan and easier to carry out on the anti-involution side. So in conclusion, this will be the sectors including the EV battery, steel, cement, and airlines. As these sectors are either dominated by the SOEs or they have very high market share from the top 3 players, or with very high entry barrier. So it's easier to set a feasible plan. Besides for steel and cement, actually they have successfully carried out the supply side reform back in 2015 and 16. So they have prior experience on that. While for sectors like auto and express delivery, we think the anti-involution remains challenged, given the market is very fragmented and is still dominated by the private companies. So it's not easy for them to reach a feasible plan. And in this report, we also provide 22 stock lists across 9 sectors. These are the key beneficiaries we think on the anti-involution C, and this is the stock list screened provided by the bottom-up analyst survey. With that, I will stop here and pass it back to Kristen.
Thank you so much, Chloe. And then now I'll invite Robin here to share the takeaway from his trip and also the key market debate.
Thank you, Crystal. So the big picture view is after our trip in Shenzhen, the China Best Conference with investors and corporates, and my trip in Beijing, talking with policymakers and advisors, what is the big picture view? On the positives, over the last 3 to 4 months, liquidity and the narrative have improved. Chloe mentioned her team's free liquidity gauge that turned positive since June. And institutional flows, especially insurance company, lifers, they have underpinned inflows into equity market. Policy is also leaning into anti-involution. So Laura and Chloe did this deep dive on, it's a messy path, but this is the beginning of a deepening of their understanding of reflation, and also some marginal consumption support. Small steps, but right direction. However, if we take a step back, fundamentals are still mixed and argue for balance and discipline. August high-frequency indicators softened, with the front-loaded exports are fading, property remains a drag, and even this earlier fiscal impulse also are fading into third quarter. And on the so-called household deposits migration into equity market, probably the number one question Laura and I got asked in our Shenzhen conference. Yes, we found the pool does exist, but the realized pace is very modest. Household built about RMB 6 to 7 trillion of excess term deposits in the last 3 years, which is the potential source of reallocation. We have seen only early shoots. About 300 billion yuan migration has happened in July and August. So that's very marginal out of these 6 to 7 trillion potential excess term deposits. And that's one of the reasons is many 2021 equity market entrants, they remain underwater and they remain very precautionary in case of reallocation towards equity-linked exposure. That's why flows are small and the volatilities like last week and this week in the market will probably slow down. So that's about the question Laura and I got asked about the potential of household deposits migration. I think the pace might be more measured than the market expected. The initial size is also smaller than many people imagined. Now, last but not least, regulators. Are regulators stepping on the brakes? Bloomberg today says regulators may curb speculations. So what is our take? We think guardrails, not brakes. So Beijing is definitely signaling incentives for long-term capital and also a more predictable, say, IPO process and a clearer short-selling mechanism. So their playbook is earlier and more targeted than 2015. They want to cool pockets of froth, but to preserve the trend. So you probably noticed Bloomberg mentioned the consultation meeting chaired by regulators, including Beijing's top CSRC chairman. Well, I think the message was balanced, consolidating positive momentum, promoting long-term rational investing, and avoid a 2015 style boom bust. And so the toolkits they are likely to use looked more like guardrails, not brakes, some window guidance, some tools on probably putting more restrictions on margin finance or quant trading, and also, as we mentioned, a more market-oriented, predictable IPO process and short-selling mechanism. That's the toolkits acting like guardrails, not brakes. So if you combine what's happening on the ground on fundamentals and the regulator's view, I think we need to be balanced. Fundamentals are still very mixed. Deflation is here to stay. They are making some steps on marginal consumption support, small steps, but right direction. Liquidity is there. There is a potential of migration, but don't bet on a big wave of household deposits into market in near term. The pace will be probably much more measured than many people imagined. So that's our takeaways from the Shenzhen conference and my trip in Beijing with policy advisors. With that, I will stop here and hand over back to Crystal.
Thank you so much, Robin. And then last but not least, we have Yamaguchi-san as well on the line. And then he has just done his marketing in Asia. Can you share your views and then your takes on investor expectations on monetary policies, and then also other key debates that you had during your trip?
Thank you, Crystal. Thank you, everyone, for joining the webcast. So I visited investors in Singapore and Hong Kong last week. And I think investors' interest in Japan macro still remain pretty high. And the main discussion points were the BOJ and Japanese politics, which is getting a little bit, messy right now. But let me start with the BOJ. My impression is that, I think probably, half of the investors we met expect early rate hike by the BOJ. I think most likely in the October outlook meeting, October monetary policy meeting, when the BOJ publishes its outlook report. But our view is that, Governor Ueda has a pretty cautious stance, especially on the outlook of the U.S. economy, given the potential negative impact from tariffs. And if you can see this slide, these are the comments by Governor Ueda at the July monetary policy meeting. The press conference after the July monetary policy meeting. The press conference was conducted in Japanese, so the content may not be fully recognized by overseas investors. But he clearly said that I think a soft data would not be enough. And BOJ needs to observe, how tariff policies affect hard data, such as exports, production, and employment in the U.S. Also, Governor Ueda said that Japan is heading towards a slowdown, mainly due to the negative impact from U.S. tariffs. So the BOJ wants to assess the extent of that deceleration, given the high uncertainty. So the U.S. has just raised the reciprocal tariff from August. So I think it would take a little bit of time for the BOJ to confirm the hard data, including U.S. employment data and potentially U.S. inflation and retail sales data, including this holiday season sales data, Black Friday sales data at the end of November. So we think probably it's going to be difficult for the BOJ staff to persuade Governor Ueda, to make a rate hike at the October meeting because of the lack of enough hard data at that time. Yesterday, Deputy Governor Himino also gave a speech, and we saw that his comment was also somewhat, dovish, in line with Ueda-san's cautious view. And as for inflation, yes, the headline inflation, Japanese headline inflation remains above 2% for almost 3 years. But it's mainly driven by food components, food prices, especially rice prices. And that is mainly driven by supply side factors, not by demand side factors. And if you look at the Western style core CPI, excluding all food and energy, Japan's CPI is still tracking at around 1.6%, below the 2% target. Also, recently we are seeing decline in import prices. In the recent data, on a YOY basis, import prices are down by 10%. So what's happening right now is that the Japanese PPI has been coming down. So now there's less pressure from import prices, and also non-food components, including service prices, remain highly stable. So BOJ has some time to monitor hard data, including the US. There's no, I think they are not in a rush to raise interest rates given the inflation development. And another issue is politics. I'm not sure how much you follow Japanese politics, but the ruling LDP lost the upper house election in July, And many ruling party LDP members are calling for early extraordinary party presidential election. This was unprecedented, and the LDP election administration committee was discussing procedure about this whether or not to have an extraordinary party presidential election, and they made a decision this week. And so any diet members or representatives from 47 prefectures need to submit a document if they call for early extraordinary presidential election. And the deadline is September 8th. That's next Monday. And the LDP rule says that if they reach the majority, half of the diet members and representatives from 47 prefectures agree, then they need to have an extraordinary presidential election. And but I think there's still uncertainty whether or not they can reach the majority. If they fail to reach the majority, then I think Prime Minister Ishiba will likely remain in power without party presidential election. But instead, if they reach the majority, then I think they need to have an extraordinary party presidential election, probably by the end of September. And most likely, Ishiba-san will step down. And the new LDP party leader will likely become the next prime minister, most likely in October. So I think potential candidates, floating around in the Japanese media include Koizumi-san, Shinjiro Koizumi, and that he's a son of the former Prime Minister Koizumi, Chief Cabinet Secretary Hayashi-san, and also Kobayashi-san and Takaichi-san. She's known for her, deflationary stance. But I think local political analysts say I think chances of Takaichi-san may have somewhat declined because a lot of her supporters, former those who are in the former Abe faction lost seats in the previous lower house election. But I think things are still uncertain. So I think this September 8th, next Monday, the deadline of the submission will be I think pretty important for the market. So I'll stop here and back to you, Crystal.
Thank you, Yamaguchi-san. And then this is the end of the first part of the webcast. And then now we'll move on to the questions. The first two questions are for Derek. Derek, can you talk about if there's any update on the 50% tariff on India, and then whether we have seen any impacts to the economy? And the second question is whether India will shift its trade focus entirely to Asia.
Yeah, thanks, Crystal. I think we don't have as much data at this point in time. The only data that we have in hand that allows us to sort of track the impact would be sort of like the PMI. And I think if you look at, let's say, the India's manufacturing PMI in terms of the new orders, I think they've sort of gone a little bit sideways. But what is interesting is that the new export orders have come down by a bit, probably about like 1.1 percentage points. And I think that sort of is generally a trend that we have also seen around the region, whereby new orders are holding up pretty okay while new export orders are coming down. So I would say that actually, if you look at that impact from India vis-a-vis the rest of the region, I think they're quite similar in that sense. So we are not really sort of seeing any I can't point towards any sort of like specific impact from the higher tariff rate on India at this point in time. Nonetheless, what we are expecting is also that as these tariff impacts start to sort of filter through, they would have a direct impact on activity, and there will also be an indirect impact on capex and trade, which would then tend to affect the region overall, including India. Now, on the second question on the whether India can actually shift its strategy completely to Asia, I think it will, to be quite honest, I think it'd be quite tough because of the fact that you do have two large consumer markets in the developed market in terms of US and Europe. And so, I guess what we're trying to say is that you need to capitalize on every opportunity that you can get in order to be able to grow at a faster rate, in order to be able to sort of generate enough employment opportunities, and to be sort of like to beef up your sort of participation in the global value chains. So that's it from my side, Crystal.
Right. Thank you, Derek. And then we have another two questions for Robin. So what are your thoughts on the initiatives to attract the long-term capital? And then also what are the updates on the ground regarding consumption and also property market?
Thank you, Crystal. So twofold. One is about equity market itself. I mentioned in these consultation meetings with regulators, my own proposal is they focus on how to provide long-term incentives for this patient money. For example, continue to enhance this dividend payout and also buybacks of China Asia, and also try to open the market with a lot of connectivity program between Hong Kong and China on mutual funds, on a lot of these new connectivity programs. Last but not least, more importantly, is about China's reflation. Yes, we mentioned the small steps, right direction, but these steps are still small. Marginal consumption support, fertility support, consumer loan subsidy, these are not sufficient to reflate. They need a much bigger rebalance reform, and that's why I believe this bigger swing factor would be this structural reform to be announced by the 15th five-year plan, which will be released in the fourth plenum of the Party Congress in late October. So in that five-year plan outline, if the signals anything, changing local government incentives, changing the fiscal or tax system, try to make more market-based resources allocation, shifting from what happened in the last 20 years, supply-side business model, into enhancing the social safety net, the welfare system for migrant workers and farmers to boost the consumption in a more sustainable way, or even putting consumption ratio, consumption as percentage of GDP, as a KPI for the five-year plan. I think these are more fundamental reforms which could boost the foreigners' interest on China equity market. But in near-term, fundamentals are still mixed. Crystal, you asked about consumption, about housing. Housing remains a drag. It's a slow burn. For example, both the new home sales and the housing price for the existing homes continue to deteriorate in the last 3 months. And back to consumers, we have saying if you exclude the trade-in consumer categories like durable goods, home appliance, cars, focus on other categories. These are basically growing at only 2%, a very subdued growth level. Anything not covered by trade-in program remains very, very subdued, partially because job market is still in a very challenging status. For example, the youth unemployment rate, despite they changed the definition, if you do seasonal adjustment, youth unemployment rate has been going up, so the job concerns are still there. So all of these are showing mixed fundamentals. Reflation is still very challenging. That's why all eyes on the five-year plan in the fourth plenum.
Great, that's super clear. Thank you, Robin. And then we have another question on China. This is for Chloe, I guess. So do you think A shares still have room to run? And then what's your current preferences for A and H within China?
Yes, sure. Thanks, Crystal. Yeah, I think for the Asia market, it has seen some meaningful pullback these few days. And we think the sentiment cool down is understandable given we have seen the bull run for the past 2 months. And also especially in the late August, actually we start to see some overheating signals, although it's more like isolated signals instead of prevalent signals. Including for our weekly Asia sentiment index. And also, if we look at the margin purchase as percentage of daily turnover, they are already approaching to the October 2024 level. At this level, we think it may take time for the market to consolidate. After the consolidation, we think the policy support and also the earnings fundamental are very important to support a more sustainable slow bull market. First, on the policy side, on the anti-involution, we think this is the right policy direction, although it's like a more multi-year efforts. And the next key catalyst to watch is the fourth plenary in late October. This will serve as a key catalyst if we could get more clarity on the anti-involution action plan and also on the structural reform. And on the earnings side, for Asia, actually, it delivered the first in-line results in first quarter results. And in the second quarter result, currently we see it has a net miss by a number of companies, but it's still an in-line result by market cap. So the second quarter result is a little bit worsening compared to the first quarter, but it is not that bad. So we need to closely to watch this to see if the fundamental can improve. And I think from the previous experience, we can learn that from the supply side reform back in 2015 and 16, actually it takes around 1 year to see the earnings inflection point after the policies has been announced. So by this time, it may take a little bit longer because it's more like a market approach instead of a camping style. And lastly is on the liquidity side. So just as Robin mentioned, we think we still have additional liquidity are still available for the equity allocation. So first is from the insurance companies. Actually, our insurance team calculated that for the first half of this year, the insurance companies has allocated around RMB 650 billion inflows into the equity market. And for the full year, they think it should be over 1 trillion allocation for the equity markets for 2025 and also for 2026, given the currently low interest rate environment. So this will be the additional liquidity driver. And secondly, I think for the households, there are still room for them to relocate from the deposit and also some low risk products to the equity market. Actually, in July and August, we have seen the money market products have seen some meaningful redemption. At the same time, the equity funds, especially the ETF funds, have seen some meaningful subscription. So this will still have room to go on the liquidity side. And regarding the H-share and H-share preference, we have been talking about the H-share may start to regain some momentum after the summer. Given currently we see first on the earnings side, the MSCI China still delivers better results comparing the A-share. The result is both in line in terms of number of companies and also by market cap, so it's better than the A-share. And secondly is that we are getting closer to the Fed rate cut cycle kicking off in September, and in such cycle, we will have the improved risk sentiment and also stronger conviction in US dollar weakness. So those are the more, this will benefit more to the H-share, the offshore market, compared to the Asia market.
That's super clear. Thank you, Chloe. We'll take one last question here, and this is on Japan. Yamaguchi-san, what's your thoughts on the priorities of BOJ? And what do you think? How do they balance their inflation and also growth target?
Yes, thank you. So the content of Japanese inflation does not show the need for immediate action. As I said, the headline inflation is about 2%, but it's mainly driven by food inflation. And so far, there haven't been second round effect from food inflation to non-food components, including services. I think high food inflation could potentially affect inflation expectations, but I think BOJ people expect the food inflation to stabilize in the second half of this year due to a tough YOY comparison. Meanwhile, I think U.S. economic conditions matter because that could negatively affect exporters' earnings, and then that could adversely affect the wage growth momentum, including the spring wage negotiations next year. So right now, I think they are now focusing on U.S., especially the U.S. data. I think one tricky part is the exchange rate. If the yen continues to weaken, then that will be problematic. But yesterday, when the yen weakened, Prime Minister Ishiba asked governor whether to come to the Prime Minister's office, and I think it's a kind of warning or a message to the market that government and the BOJ are monitoring the exchange rate. But overall, I think I would say now the US data will be the most important one to watch. So I stop here and back to you.
Got it. Thank you, Yamaguchi-san. In the interest of time, we'll conclude today's podcast here and then answer remaining questions offline. If you find this session useful and want to join our other series, or go to the Asia Research Landing page on the portal for a collection of the region's most important research in our audio-video series. Thank you so much for joining us, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.